Well, tariffs were back in focus last week after President Trump issued letters left, right, and centre telling trading partners of the United States what they're going to need to pay. But that new deadline is not until the 1st of August, leading markets to bet on another escalate to de escalate taco moment not being too far away. The week ahead, though, looks set to be a busy one. Of course, those trade headlines are going to be eyed. We've got a busy data docket, including the latest US inflation and retail sales figures prints, and we've also got inflation due here in the UK too. Not forgetting the start of Q2 earnings season on Wall Street as well, which gives plenty for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's crack on with the show. So the issue of trade and tariffs in the limelight once again last week as we move past one trade deadline, the 9th of July, with nothing really happening as the can is kicked down the road to the 1st of August. But the Treasury Secretary already saying it could be Labour Day before the whole issue is wrapped up. Joining me, as always, to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forexflow Live and Forex Analytics. And Ryan, very pleased to see you in a much more restrained and conservative outfit this week.
Yeah, well, I'm saving the best till last, and our lunch in just over a week's time. So you'll see it when I pick you up from the station.
I cannot wait.
Oh, you can.
I'm sure I can. I may be, turning around and getting on the train next train home, I think.
Yeah, well, it might be cancelled. You know what these train lines are like at the moment.
Well, yeah, that is very true. Too hot, too wet, too cold, whatever, some sort of excuse. Anyway, excuses is probably the name of the day when it comes to Trump as well at the minute, given all the tariff delays that we continue to see. So let's get into the meat of that in Topical Thunder. So the president has been busy with his pen over the last week or so, or at least an intern in the White House has been, because they're probably the ones writing all of these letters. Effectively, everyone seems to have received a letter informing them of a new tariff rate that they're going to be paying from the 1st of August. Now, I'll be completely honest with you, there doesn't really seem to be any logic whatsoever to the rates that Trump has put in these letters. Some are a little bit higher than those seen on Liberation Day, and some are a little bit lower. I guess the big ones, or the ones that have grabbed all the headlines, are Japan and South Korea at 25%, the EU and Mexico at 30%. Those two were announced on Saturday. We also have Canada in the mix at 35%, and then Brazil at a whopping 50%, although that latter one does seem very politically motivated, and there are a few sort of idiosyncratic factors going on there. Trump has also touted the potential for a blanket 20% tariff on those countries that haven't received a letter yet. So I guess that those uninhabited islands just full of penguins near Antarctica, they're going to be paying 20% on whatever the hell they might export to the US. Not that would be a lot. We've also got a whole host of sectoral levies in the mix as well, with copper being subject to a 50% tariff from the start of August, and semiconductors and pharmaceuticals probably in the mix before too long as well. Now, if you take all of that at face value, put it together, you end up with an average effective tariff rate from the 1st of August, which would be kind of in the high teens, probably 17, 18%, which is roughly where it was on Liberation Day. So you kind of ask yourself, well, why have markets not fallen off a cliff and started panicking about it? Well, the very short answer is no one believes that it's actually going to happen. None of these tariffs, whether they be the sectoral measures or the country-specific measures, are due to take place until the 1st of August, which is 2.5 weeks away today. And I mean, that may as well be about a century, given how quickly things are moving these days. So the market's bet is that this is just a bluff from President Trump, that this is a negotiating gambit. He's escalating the situation to de-escalate it again relatively rapidly, and it's all just one big taco trade once more. Now, you could argue it's a complacent position. Well, maybe that's true. I mean, maybe you'd say that with the S&P trading pretty much at all-time highs, Trump would be a little bit more emboldened to maybe go a little bit further, maybe actually, follow through on these threats. Or you could argue that it's logical to conclude that this is all a bluff. Certainly, given recent form, that is the position that I am pretty happy to take at this moment in time. I think this is the way that Trump likes to do deals, and I think the market has finally wised up to that fact. Although I would caution things could get little bit more jittery, even when the clock does tick down to the 1st of August, and there is a lack of progress if that does indeed come to pass. But I think for the time being, it's very much a case of this is the negotiating strategy. We're all very used to it, and the market is going to be pretty good at shutting out the noise for the time being, I would expect.
Yeah, well, I'm glad he didn't send the letter to the UK, because with our postal service, it probably won't get it till Christmas and well after the deadline. But that's
Probably
another
on
story.
strike again.
Yeah, we're quicker to walk it here. Maybe bring it over when he's coming to Scotland.
Yeah.
And give it to Trump. Give it to Starmer directly. But yeah, I mean, we had the make of this coming into last week and the tariff deadline. We knew Trump was going to play bad cop. He's got all his minions out, Lutnick and Besson and Hassett and all the rest, doing all the negotiating, and he's sitting there in his office thinking, right, I haven't heard anything, so let's chuck a letter out and stir things up. But we know that the market is going to ignore all this now. It has when we saw those EU notifications and the Mexico ones. We saw a little bit of a blip in the euro, and it's all back where it started. So yeah, the market, as we expected, switching off from that now, and it's going to move on to other things.
Yeah, absolutely. And I mean, there's certainly a risk that these tariffs do come into play. And I think, as we get closer to the deadline, that risk becomes much higher. But again, you kind of go back to that fundamental point, which is that the admin have shown us on so many occasions that they either don't want or simply can't deal with tariffs at super high levels. So, it does all just look like one big negotiating gambit. Although I would imagine that President Trump is not particularly happy that his trade advisor, Peter Navarro, went on the television at the back end of last week and went, well, the letters are just a negotiation, which does rather water down the severity of the threat that I think he was hoping to deliver.
Yeah, absolutely, and he probably got a slap across the wrist for that one. But it's been the theme all the way through this. I mean, Trump's probably going to settle somewhere probably between 10 and 20% on tariffs, and the market will forget about it, and everyone will know how to circumvent them or reduce prices even just to combat them and flatten them out. So yeah, he may get his little pound of flesh, but yeah, I certainly. More importantly, I don't think we're going to get this big inflation wave that a lot of people are worried about, particularly Mr. Powell at the Fed.
Well, we can get onto that momentarily. But before we do, you want to talk about geopolitics, I believe.
Yeah, so we're talking about getting over the tariff deadline and what's the market going to focus on next. And the deadline for the tariffs is the 1st of August. So it's 2.5-3 weeks that the market's got to find something else to trade until then. So that focus, I think, is going to shift to this Russia-Ukraine situation. We have Europe ramping up the rhetoric with further sanctions, arms shipments to Ukraine, alongside Trump getting cheesed off with Putin over lack of peace progress. He's also going to be up in arms to Ukraine, as well as apparently making a big announcement, which will likely be known by the time you see this recording, which again is expected to be potentially about increased arms and maybe sanctions and other bits and bobs. So we know that the market always needs a bone to chew on, and this situation is likely to come to the fore this week. Monday morning, the market seemed less bothered about the weekend tariff stuff, and we saw a bit of European risk off, if you want to call it that, which is a bit of a move into the US dollar. So we might just be starting to see the switch into risk trading geopolitics this week. We're once again, though, going to be at the mercy of the headlines and truth bombs over this situation. So knowing how the market will react to good or bad news will be important. Now, gold will be the cleanest trade or asset to watch over all this. But know that bad news could possibly see the dollar gaining, which goes against what we've been seeing recently. That'll be likely at the expense of the pound and the euro. Now, stocks might also suffer, but that again might be more geographically related to closeness to the conflict and depending on how these headlines go. So this could be yet another situation where we have to trade this week in a wholly different way to last week, as the immediate news will override all the longer term themes that are going on.
Yeah, I think certainly speaks to the need to be agile and not stay married to a view for too long
Yeah,
once again. But yeah, I love how you go from one never-ending subject of trade to what sadly seems like another never-ending subject, which is the geopolitical shenanigans. Because as you say, obviously the human cost of all of this is tragic and is significant, but we seem to get a ramping up of rhetoric and then nothing happens for about a month, and then rhetoric ramps up again, and then nothing happens for another month. So yeah, whether this actually does prove to be a definitive end to proceedings or another sort of instalment in that series, I guess remains to be seen.
yeah. I think the risk is predominantly this week from Trump is how strong is he going to go against Putin? I mean, he's obviously been talking since before he was elected that he was going to stop the war in day one, and how
What
Putin's
are we now?
reasonable.
Day 121, something
Yeah,
like that?
exactly. And so Putin's pushing his buttons because he's not seemingly looking to get a deal done, and particularly while he's still making gains in the Ukraine. So he's trying to grab as much territory as possible. So how long can Trump sit there and go, oh, he's all right, we're going to get a deal done, before he has to really start ramping up the narrative, and it could be that we get that this week.
Yes, well, only time will tell on that front. And as you say, we are due to get this big announcement at some point on Monday. So yeah, if you're watching this on Tuesday morning, then maybe skip this section because given what Trump's like, we might have to tear the script up entirely on that one.
Well, if you've got a time machine, let us know what happened.
Yeah, and then tell me the lottery numbers on Friday night as well while you're there, please. Right, speaking of the lottery, I think we could do with winning that here in the UK. It's about the only thing that's going to solve our fiscal woes, I think. But it is nevertheless a busy week up ahead here in the UK, even if the usual warning around needing a pinch of salt in interpreting the data is still required, given the rather shambolic nature of the ONS. In terms of the data that we have up ahead this week, on Wednesday, we have the latest UK inflation figures. Headline CPI, that is seen holding steady at 3.4% on a year-on-year basis in June. But the services CPI metric, which of course the BOE watch very, very closely as a gauge of underlying price pressures, that's set to fall to 4.5%, down from a prior 4.7%. So that may put to bed some concerns about the risk of persistent price pressures. Although I would say that those risks are still, in my mind, very, very misplaced, given how weak the labour market is at the moment. And of course, we get the latest UK jobs report on Thursday. Now, unemployment, that is seen holding steady at 4.6% in the 3 months to May, but earnings growth in terms of regular pay, that's seen dropping back below 5% for the first time in a couple of years, while the HMRC payrolls metric, that is probably going to fall once again. This data, of course, being for June. We have had 7 drops in a row in terms of payroll employment here in the UK every single month since the budget last October. We have seen the number of payrolled employees decline after that national insurance raise, and we're likely to see that again in June, particularly with both the PMI surveys and a KPMG survey out overnight pointing to a faster pace of labour market deterioration in the month of June compared to that which we saw in May. So I think Thursday's data is likely to be relatively grim, and not only will cement the case for a 25 basis point BOE cut at the August meeting, but hopefully will also allow the BOE to take a much more dovish approach and actually deliver a faster pace of easing as we move into the autumn. And that's something that Governor Bailey was flagging the possibility of in an article in the Times this morning. Now, on top of all of that, we had some bad news for UK PLC last week. Not only did we have the economy surprisingly contracting on a month-on-month basis in May, so that's 2 monthly contractions in a row now, and almost certainly nails on a quarterly contraction in Q2. We also had the OBR saying that debt GDP will probably be north of 270% within the next 50 years. Now, that sounds a hell of a long time away, but once that ratio gets above 100%, it tends to balloon and doesn't come back down very easily. So all of this adding to the Chancellor's woes as we move closer to the inevitability of sizable tax hikes in the autumn budget, another nail getting hammered into her political coffin by the day, it seems, and she's going to stand up at the Mansion House dinner on Tuesday night and insists that she has a grip on the economy. Now, when a chancellor's having to do that, I think it tells you everything you need to know. And it's certainly, in this sort of an environment, I still find it very, very difficult to have any bull case for the pound, and certainly not have a bull case for the long end of the gilt curve.
Yeah, well, her standing up in Mansion House, she's going to get pelted with rotten tomatoes, or saying she's got a grip on the economy is a bit like giving football manager the old vote of confidence.
Give it a big Sam until the end of the parliamentary term. He can't do a worse job.
Possibly, yeah. Probably knows more about economic. Easy for me to say. Probably knows more about economics than she does.
And coming from a West Ham fan, that is high praise.
Well, here we go again. But anyway, back to business. I'm not sure I say back to business. I'm not sure the data is going to get any better from the ONS, because I got a letter dropped on my desk that they want me to take part in an economic survey, since I'm a business owner. So I'm not sure the data is going to improve that much.
They must be scraping the barrel if they're surveying you, mate.
Exactly. If the first question, how do you think Rachel Reeves is doing with the economy? Well, I'm probably going to be in that one for an hour.
You'll have to ring up and ask him to send you a bigger form.
Exactly. Not enough data space. But anyway, so we got all this data coming out. If it goes, I don't know what you want to call the right way. If we see inflation going the right way, then obviously that's going to, as you say, seal the deal for another cut in August. As for the jobs data, it has been looking grim, which again begs the question why they didn't feel the need to cut sooner or cut faster, as you point out. Let's hope they don't get in a situation where they're going to have to be chasing the ball down the pitch and having to play catch up rather than being in front of the move, which they never usually are. So the wages numbers, I think we've got to be careful. That's been really, really sticky, and now we've got the potential junior doctors on strike again for another 28-29% pay rise that they want. In August, I think we're going to get some more public sector pay deals going through, which is again up around that 4.5% mark. So any downward shift in wages that we see probably going to have to come from the private sector, or else we're going to see these numbers remaining sticky or going back up again if we see any drops over the next couple of months. So there's no smoke without fire, and the old Bank of England, they're never far from that rock and hard place.
No, absolutely not. And I believe, and I'm sure someone in the comments can correct me if I'm wrong, but I believe that in the 3 months to April, which was the last jobs numbers, public sector earnings growth was actually outpacing that seen in the private sector, which is not a particularly good sign at any time, certainly least of all when the government are supposedly demonstrating fiscal restraint. Handing out sizable pay rises to public sector workers probably isn't the best way to do that. But there we go. As you say, it does seem like we're going to be getting into a whole nother round of strikes and pay negotiations and sort of doing what we did last year all over again, potentially.
Oh, yeah, like Groundhog Day, isn't it, really?
It really is.
And none of it is likely good for the pound either.
No, absolutely not. And none of it is particularly good for Rachel Reeves' headroom. But I guess let's move on to what is going to be the main release of this week, which is not coming out of the UK. It is coming out of the US tomorrow afternoon.
Yeah, a country that can actually get their data right. It's nice to see.
Well, ish,
yeah. But, this is a bit of a position that Power's got himself into. On one hand, his job is to contain inflation, yet if he actually gets higher inflation this week, it sort of justifies his stance for keeping rates on hold. However, if inflation does drop back, he's achieving the Fed's mandate, but then gets it in the net from Trump from being wrong about inflation and keeping rates on hold. So he's a bit damned if he does, damned if he doesn't with this data at the moment. Now, CPI is expected to tick up 2 pips to 2.6% year on year in the headline number, and with the core also going up 2 points to 3% from 2.8% previously. So anything I think on the money or higher will have the market squeezing out any remaining expectations for a July cut, and will probably lower expectations for September as well. Now, if we see the numbers coming in lower than expectations, staying unchanged over last month, or even dropping below last month, that will really put the cat among the pigeons over the July FOMC, and we should expect a full-on barrage from Mr. Trump. Which that sort of brings me to my next point, and a bit of an early heads up for that July FOMC. Now, assuming there's no drama from the CPI data and the Fed is looking to stay on hold, the big news from that FOMC will likely be not the rate decision, but who could dissent. We know at least two members, Waller and Bowman, should dissent from holding rates, given their views recently about cutting. But the real surprise would be anyone else joining them and how many. But back to the data, for me, I think the shorter end of the US bond market needs watching closely over this data, as a really soft CPI number will raise the case for cuts. And I've been looking at the 2-year yield here and got a bit of a zone here between 350 and 364. And if we're getting softer numbers from CPI, then I expect this to get knocked through those levels, and probably the dollar's going to follow.
Indeed, yes. Apologies for my sniggering there. I noticed a headline come up about US-EU trade negotiations, and the EU trade chief Sefcovic says, and I quote here, "It takes two hands to clap." I mean, what sort of an analogy is that to describe what's going on?
I can clap with one hand.
Right, well, while you work out whatever the hell that was, I'll talk about inflation. I'm going to throw it out there. I don't think the inflation figures are really that big of a deal this week, to be honest. If it's a soft number, from a policy perspective anyway, from a market perspective, definitely. If it's a soft number, then it's a case of, well, all of the tariff-induced inflation is delayed. The Fed are not just going to look at one report and go, oh, great, we can start cutting again, even though we know their bias is towards lowering rates. If it's a hot number, then, as you say, the Powell and the rest of the FOMC are going to be vindicated in their view that, staying on hold and just seeing what happens is the right policy stance at this moment in time. There's going to be a lot of political noise. Around the data. If it's a soft number, then Trump, as you say, is going to be coming out all guns blazing in terms of trying to attack Powell, trying to force through those rate cuts, and all of the other usual suspects, Hassett, Lutnick, etc. And if it's a hot print, then I wouldn't be at all surprised to see that those very people blaming US corporations for passing on the cost of the tariff that the Trump administration has imposed. So it's going to get very, very messy from a sort of political perspective. But I think from a trading point of view, it's a case of, is this one print going to materially shift the Fed's outlook over the near term? Certainly not for July. Will it mean that we get a cut in September? Potentially, but you're going to need the July and the August CPI prints to behave themselves as well in order to unlock that. I think it could be a case of a lot of noise, but very, very little signal from the data that we get.
Yeah, and we've been speaking about this before, how, going into the latter part of the year and, Trump going to be nominating his next Fed head, it's all going to become political. Waller's stepped into the political realm. And it's just a question, I think, this FOMC is how many others decide they want to, talk on the political side of things rather than on the direct monetary policy side of things.
Yeah, basically how many of them want to vie for promotion and how many of them actually want to do the right thing and set the appropriate monetary policy stance for the economy they're faced with. Clearly, as you say, two of them, Waller and Bowman, are happy to pin their flag on Trump's mast and call for rate cuts. I think the other 17 members of the FOMC are doing the right thing and looking at things more objectively. But only time will tell on that front as to when they will deliver that rate cut. As we've said numerous times, they are above neutral. They want to get back to neutral. Powell has said if the tariffs weren't there, they probably would be back at neutral already. It's just a case of having the confidence that you're not going to see enduring inflation from those tariffs before you deliver those cuts and sort of resume the trajectory that we were on towards the back end of last year.
Yeah, absolutely. And but I think there's still going to be a trade over the FOMC, but we'll save that for near the time.
Well, yeah, indeed. We've still got 2.5 weeks, 3 weeks to go until the next Fed meeting. So don't peak too soon, mate. Speaking of trades, though, let's move on to our plays of the day. Right, I'm going to be looking at gold this week, which has been a little bit dull to be honest, over the last kind of 6, 8 weeks or so. Other precious metals haven't been. Silver's been rallying quite strongly. Platinum and palladium have traded well at times as well. But gold has been stuck in a relatively tight range, and this sort of 3,300-ish region has proved pretty solid support for the most part. But on Friday, we closed back above the 50-day moving average once more, so that puts the bulls in the driving seat over the near term for a technical perspective. And then, of course, for a fundamental perspective, you've got that ongoing tariff uncertainty that we mentioned at length earlier in the show, and also those continued outflows from the dollar, which did pause a little bit last week, but one swallow doesn't make a summer when you're dealing with sort of changes in reserve asset allocation. And I think that buying demand, certainly from some of the emerging market central banks and certainly those policymakers in Asia, that is not going to be slowing down anytime soon. So I think the path of least resistance continues to lead higher for the yellow metal. In the short term, if we're above the 50-day moving average and above this $3,300 an ounce reason, then it's a buy on dips. And I certainly wouldn't rule out fresh highs this year. I know everyone seems to have gone a bit downbeat on that prospect, but we've still got 6 months of the year to go, 5 months of the year to go. If we can get above 3,440, which is that sort of double top region from April and June, then why can't we take on $3,500 an ounce before the year is out? I would not be ruling that out at all. Ryan, something else that tends to be rather dull is the Aussie Kiwi cross.
Oh dear, mate. I'm just glad you got through that trade today without doing a gold pun like you usually do. I'm sure that the dull comment was partly in there, but yeah, it makes a change.
Well, I don't want the puns to lose their luster. That's the problem.
Oh, God, loud. Where's my cards? I haven't got my cards ready. Yeah, you get let off. I'll save that for next week. I'm looking at Aussie Kiwi this week. Despite Michael saying it never goes anywhere, it's actually moving somewhere. It's been on a very strong run, which is taking it up to some big range levels that I played short last time we were up here. I'm looking again at the 110.20 to 111.70 area to build a bit of a short to play the range again. This one is probably going to play out over a few weeks, so probably won't be reporting on it too often. But if it goes to plan, I'll be looking for another move back down to that magnet at 108. As you can see from the chart there, it's been in I think it's a 14-year range that we've been stuck in, and we keep coming back to that 108 level, then moving away to the edge of the range. So another range play for me, please.
Good stuff. Thank you, Ryan. Well, that does bring us to the end of another show. Thank you very much, as always, to my good friend Ryan Littlestone from Forexflow Live and Forex Analytics for joining me. Thank you to our producer, Kyriakos, as well, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets or anything you would like us to discuss next week. On which note, someone actually said, can you discuss oil in this week's show, which I completely forgot. But Brent has reclaimed $70 a barrel for the first time since the Israel-Iran ceasefire a couple of weeks ago, which seems odd given that OPEC Plus are continuing their war for market share, and even the Saudis are pumping way above that OPEC Plus quota. So it feels like that's built on very, very shaky foundation. So we'll see where that heads over the next week or so. But
I'll talk about it next week. I'll make it. There we go.
Well, you better make a note because I will forget. So apologies to whoever that was. I promise we will cover crude next week. And that is when we'll be back with another episode of The Trade-Off. Have a very good week ahead, and we'll see you in a week's time. Thanks for watching. Goodbye for now.